So again, today it's all about sharpening our skills. We're doing this over the weekend since the market is closed. It's perfect time to going ahead and putting some time to develop our understanding of how the markets work and what are the different possibilities and how to take better advantage of them. So this is the goal for today, will be sharpening our skills. And to be more precise, today I would like to begin to address something that I've been mentioning for a while now, which is the damage control mode. There are times that we execute trades and they work very well, but there are also times where we execute trades and they work less well, and the market starts moving against us. Obviously, this is something that we cannot do much about it, because when the market moves against us, obviously we don't have control over that. And hopefully, before you executed the trade, you had a clear plan, a clear and neat calculation of the size of the trade to be executed, and therefore you knew exactly what the risk involved was. So, in other words, even if the market went against you, it's not that big as a deal. Having said that, because options are very versatile as an instrument, we'll be able to implement at times certain tweaks to our methodologies or strategies, and thanks to that, either diminish the size of the loss you were ready to assume, or maybe convert as a loss into a small profit or something like that. Okay, so this is what we have been calling damage control mode, which is quite useful at times. And obviously there are many ways on how to implement damage control. Some of you are quite expert when it comes to understanding options. I know some of you have been trading options for a while, so you know that there are many different types of combinations that we can implement with options to obtain certain benefits. But again, always looking for a good balance between efficiency but also simplicity. So today I'll be exposing you to two different ways on how to change your mode from purely trading mode to damage control mode, and therefore in certain cases exit a trade with a much better outcome than what the ultimate outcome would have been. Okay, so that's the idea, and it's gonna be fun. Okay, it's gonna be fun. I know some of you are quite interested, and hopefully it will make sense as I conduct the session. Okay, so let's begin. Good to see you, John. Good to see you, Mario. Subhash, how are you? Orlando, good to see you all. Anyway, so disclaimers, so we can start. Okay, the following videos, clips, demonstrations are for educational and instructional purposes only. Tradictive provides these videos purely for the purpose of demonstrating a method of using the product. Users understand that all the content used in the video is purely for demonstration purposes only and is not a guide and does not provide any indication or prediction of actual results. As a user, you understand and agree that hypothetical results obtained through a demonstration do not indicate in any way the results you may receive when using our products. Great, we have it. Okay, so we have the intro slide. The session has been officially introduced. Here is our beautiful TradeStation with our even more beautiful shiny UFOs in the background. So we are ready to begin. Okay, and I also need in sharpening sessions, obviously, I also need a piece of paper where to take notes, isn't it? And therefore we're gonna start working on that to talk about how to switch from normal trading mode to damage control mode. Okay, and again, I remember once I was referring to damage control mode, and I was using an analogy with Formula One, which is one of my favorite sports. And again, damage control mode means that when things go bad, the idea is to minimize the problem. That's what damage control mode means. Okay, the reason why I'm mentioning this before we start is because out there in the industry, and I'm going to be a little daring with the words, if you don't mind, and I mean daring because English is not my first language. So I've seen in the industry a lot throughout the years, and there are people out there who do have English as a first language, where sometimes they use the term repairing trades. Okay, this is I would say a little bit daring as a term. Okay, and hopefully you don't mind me to say it this way, because repairing a trade gives you the understanding that you fix the problem. Okay, and this is not the case at all. When a market moves against you, you have a problem, and normally the problem will remain as a problem. Okay, so the idea is to try to minimize the problem, and ideally, which will happen few times only, ideally a loss end up as a small profit. Okay, that, if you wish, that would be a repair. Okay, but this is going to happen very few times because many conditions would need to take place in order for a trade that moved against you all the way was to somehow magically come back to the profit area. Okay, so I want to make sure that you all understand and you are realistic about this concept about damage control mode. It's like, let's say you are a Formula One racer and you are on the grid about to start the race, and next thing you know, your engine goes off, the lights go green, all the cars start racing, and next thing you know, let's say you were second in the grid, and now you are last. So turn on the engine, begin racing. Okay, so what's the normal outcome? The normal outcome is that you end up last. So what is damage control? Well, damage control maybe would be to work on the strategy on when you change tires, when you add gasoline to your car again, depending on the type of car you drive. So, all those different tweaks on the strategy may end up having you, instead of ending last, maybe you end up 10, 9, and you know what? Now you scored a few points. Only a few. I mean, if you had done second or first, you would have scored plenty of points. That was the goal. You ended up scoring 1 or 2. Okay, so that's damage control. Okay, the idea is to minimize the problem. Okay, but make sure you understand that we cannot do magic, and that would be great. I wish I had the power to do magic with the markets, but the most we can do is to be intelligent and manage our risk. And again, when we are in a situation which is problematic, try to minimize the problem. That's going to produce much better outcomes instead of trying to do magic and fix the problem, converting a losing trade into a profitable trade. I'm not saying this is not possible, but in the real world, it's going to happen few times only. Okay, so this is something that needs to be very well understood. Every time we do damage control, we will attempt to go back to profit, but at the same time, the reality is that most of the times that when we switch from normal mode to damage control mode, what will happen is that we end up reducing the loss we were going to get by a certain amount. And this, if you do that a bunch of times throughout the years, at the end of the year, it makes a massive impact. But again, I want to make sure everybody got the mindset in the right place when it comes to understanding what damage control mode means. Okay, so we are not talking about this daring concept out there of repairing trades. It's a little bit too optimistic. Okay, very good for books and theory, but in the real world, remember, options are priced based on the price of the underlying. If the underlying moved against you by a lot, it's going to be very difficult. Is that making sense? So again, we have to be realistic first. Okay. Having said that, there are really very nice ways on how to tweak certain situations to really minimize the problem. Okay. So let's begin with understanding the two main groups that we're going to use for damage control. Okay. And the two main groups will be damage control for directional trades and damage control for non-directional trades. Okay, those are two groups where the way we're gonna apply damage control will be totally different. Okay, totally different. So directional trades, okay, the way on how we're gonna manage that problem and try to end up in a better position will be by using gamma. Okay, so that's why last weekend we talked about gamma. So it's gonna be all about gamma plays to try to offset the problem and go back to where we need to be or minimize the problem. Okay. When it comes to non-directional trades, well, think about it. Non-directional trades are trades where you sold options. Because you sold options, you don't have positive gamma. You have negative gamma. Okay. So everything that we covered last weekend on how beautiful it is to have positive gamma, where when you sell options, example would be an iron condor, which is a non-directional trade, right? Or a credit spread. So every time you have done something like that, well, you are negative gamma. Therefore, gamma, you cannot do anything with gamma that helps you. Okay? You cannot do anything with gamma that helps you. So then we're going to have to use something different, which is going to be theta, in order to help yourself to fix the problem. Or again, now I'm the one being daring now when I say fix the problem, but you got my point, isn't it? So this is the two key concepts that I want to expose you to as we begin with the process of looking at how we can switch mode to damage control mode. And again, today in the session, I'm going to keep it, as I said, efficient and simple. Okay, so I'm going to show you one way on how to manage switch mode to damage control mode for directional trades, and another way for non-directional. And again, in the world of options, we can get super advanced, super complex. But today I will just keep it very simple, straight to the point. One approach for each type of trade. That's it. Okay. So let's say you get in a directional trade, and the stock moves against you. So what can you do? Okay, what can you do? Well, option number one is, as I said, using gamma. Using gamma would be using shares of stock against the options trade. That's what that means. Okay, so let's say you do a bull call spread. Okay, you do a bull call spread, and as you do the bull call spread, the stock starts moving against you, and there is a moment in time where now you use shares of stock against the options trade to minimize the problem. Okay, so that will produce the effect that we discussed last weekend when we did sharpening together, in the sense that your options will have a changing delta because of gamma, where the shares of stock against the options trade will have a fixed amount of delta that doesn't change because stocks got fixed delta. Therefore, as the stock moves back in your favor or further away against you, okay, in both cases, you will reduce the problem. And ideally, if the stock was to move a lot against you or a lot in your favor, then the losing trade would go back to become a winning trade. Okay, that's the idea. Okay, so I think that probably many of you have in your mind an example that we had a few weeks ago, actually it's probably a couple of months ago, something like that, with Starbucks. Okay, and I believe that some of you are in this trade, isn't it? I'm sure some of you are, or were at least. Maybe you already taken some profits. But this is a trade that, if I am not mistaken, we entered around this area, okay, where the little hen is, okay, more or less at that time. And when we entered this trade, we had to suffer a pretty massive move against us to finally have the stock move away. Okay, well, we said many times that stocks are fragile, and we need to be open and ready to assume those movements against us. And we have also said that in order to balance out these type of problems, normally when you construct a portfolio, you always have long trades and short trades. So if the market was to push down aggressively and therefore drag many stocks down together, well, yeah, the stocks you're long would suffer, but the stocks you're short would enjoy the move. And therefore you kind of balance out the problem in the portfolio, right? But now looking specifically one trade at a time, even though I just said we should be happy absorbing certain moves like that against us before the stock begins now moving in our favor, well, the fact is that if that move is too large, the short positions you have in the account may start not really helping either, because that some stocks may drop further than what is desired. And therefore, even though we are not going to use stops, right? Because we said many times in the sessions that when being directional with stocks, we know there are multiple external forces to the stock that influence the stock, such as what is happening in the S&P itself, what is happening in the Dow Jones, what is happening in the indexes, what is happening in the sectors. And all those external forces will influence the stock, where we have seen cases where the stocks have some UFO somewhere, price goes through, and next thing you know, it goes back to where it should go. And it's not that the UFO was not there. It's the fact that, that UFO belonged to a stock, and stocks are fragile, which means that any time, because of the sector or the market or whatever, the institutions, the large market players that added those on-field orders may have decided to cancel the orders. And therefore, even though you have a UFO on the screen, it didn't produce the bounce that was expected. Okay, so all those things could happen. Okay, so again, I'm repeating myself. We should be open to absorb moves of stocks against us for them ultimately to move towards the need to move. But if the move is too large, then there is a moment in time where the pain is too much, and now even though you know that when you buy options or when you do spreads, the most you can lose is what you pay for the spread, and therefore you are managing your risk even though you are not using stops. The fact is that there is a moment in time where now you fall into hoping mode, which is please come back, okay? And that hoping mode is never a good idea, okay? Never a good idea to be in hoping mode. You should always have a plan so you are never in hoping mode. So therefore, let's go back to that particular date, okay? So let's say is May 15. Let's pretend it was May 15 when we executed this trade. So I'm just gonna go back here to change my date to May 15. May 15, 2019. So May 15, and probably we're looking at the 55 in the time frame that day. Probably that day we were looking at the 60. And I believe, if I'm not mistaken, that the instruction I gave you is that if that market goes through the red UFO, if the market goes through the red UFO, that means that is it. Okay, that means that the sell on field orders has been taken out. The market that stock begins making all-time high. You may not have a retracement, okay? You may not have a retracement, and I gave you a special instruction that day that, I said, okay, take the trade up here, right? And sure thing, okay, this is what we did on that day. So let me go ahead and draw a vertical line so it's clear on the screen what was the day of the instruction. Then, when looking below, again, the instruction was a little different than normal, right? Normally, we wait for price to come into a green UFO to take the trade. In this case, because it was an all-time high type of situation, we said if it goes through the red, it means the on-field orders to sell were canceled. When on-field orders to sell are canceled, they normally become buy on-field orders. Therefore, new green UFOs are about to appear. So I said buy above, right? So again, I'm just repeating myself. But the next question is, okay, so we're going to buy above, but what if instead of keep going higher, what if it starts falling down? Well, then the good news was that, okay, well, we got a bunch of UFOs below price that are likely going to protect us, okay? We don't know which one is going to be the one that works the best because stocks are fragile. They depend on other external forces. But you know what? The fact that there are many, it's a great type of, I was going to say guarantee. It's never a guarantee, but kind of like a guarantee in the sense that, if it doesn't bounce from this one, it's going to bounce from the other one, if not from the other one. So in other words, if it was to cross all those UFOs available right now, if that stock was to go below 72, well, probably that would mean that something very, very wrong is happening because we know that stocks are influenced by external forces. But if none of the UFOs does anything, well, probably it means that the whole stock is now changing and becoming a complete downtrend, complete different market environment for the stock. And therefore, you need to switch from normal trading mode to damage control mode. Okay, so basically by observing this chart, you need to set a place on the chart. Of course, we use the UFOs for that, but you need to set a place on the chart that tells you when is it that you're right, when is it that you are just waiting for the stock to begin because the force is also influenced by external forces, and when is it that you're wrong, right? So now, if we were not to use damage control mode and the stock was to fall below 72.17, then that's when you fall into hoping mode. And again, it's not an uneducated hoping mode because you know that if you buy an option and it costs you $200, the most you can lose is $200. So, you are hoping it's going to come back, but you're not hoping in a way that is uneducated. You are hoping in a way that is controlled when it comes to, how much is the worst case, which is $200. But at the same time, it's still hope, right? So what I would like to do now is to give you techniques where if that stock was to fall below 72.17, okay, we enter what I will call that damage control mode, where now the stock has been proven to not to work well anymore. It's like, that Formula One racer that got the engine, got a problem with the engine on the starting line, on the starting grid, and could not turn on the car, and everybody started, and now finally the guy turned on the engine, and now is last in the race, right? So you are not hoping, you are simply going to execute a different plan, okay? That's gonna be the damage control mode, okay? So basically, let me repeat myself and let me summarize what I said. When you plan a trade, you need to have the rules for you to enter, the rules for you to take the profits. You need to have a defined area on the chart, which is where you're waiting for the stock to begin, because we know stocks are influenced by external forces. But you also need to have, and this is new, you also need to have a condition that defines when is it that you switch from normal mode to damage control mode. Okay, and in this case, I'm going to use 72.17 as that triggering condition. Okay, so please go ahead and tell me if up to this point everything is clear. Give me some confirmation on the chat box if that's okay. Yes, very good. Yes, I can. I'm reading you, Orlando. Yep, got it. Yep, nice, perfect. Okay. So anyway, so let's continue. So what would you do that day? Okay, well, that day, okay, what you did that day, right? I believe that the instruction I gave you that day is to buy a call. Okay, buy a call. And I don't remember which one, but let's go with the 80 call. And I do remember that stock with the report earnings in July. So let's say you use the July 19, 2019 call, okay, and that's the one that you bought, okay? So you bought the 80 call with July 19, 2019 expiration, okay? Good. So now the question is, well, before I go for the question, the other option that you could have is instead of buy the 80 call, so maybe another valid option could be buy the 80 call, okay, and together with that, you would also sell maybe the 85 call, and now you would do a spread, a bull call spread, using the same July 19, 2019 expiration date, instead of doing just a regular naked call, okay? That would also be valid, but in this case, I'm just gonna, and it's gonna be very similar, but in this case, I'm just gonna go with the 80 call, because that was a scenario where we were going to start making all-time highs or potentially make all-time highs, and therefore I didn't want to cap the profit of the trade. Of course, if I use the 85 against the 80, I am capping the profit to be $5. Is no way I can make more than $5, which in normal cases, when you're not making all-time high, this is what we do all the time. We do a spread. But in this case, it was a trade where there was a very large potential for a profit, and we didn't want to cap that profit, okay? So I'm gonna start with the assumption that you bought the 80 call. Now, if you bought the 80 call that day, okay, the question is how much you paid, okay? And in order to do that, so what I'm gonna do is I'm gonna bring another tool in the room. I'm just loading it here. Here we go. So I am now loading a tool provided by a different platform, which in this case is Thinkorswim, and I am using a very interesting tool within this platform called ThinkBack, where I can just pick a date, and that was, what day was that? That was May 15. So I can just pick a date, and the moment I pick a date, you know, I'll be able to access historical values for those options. Okay, now again, those historical values are gonna be at the end of the day, so you know, I'll take it as good, even though the real prices will not be exactly like that, but kind of. Okay, so what I'm gonna look at is I'm looking at the 80 call. So notice I'm looking at 80, notice I'm looking at the calls, and notice I am also pointing at July 19, 2019 expiration. And when you look at that, you can see the bid and the ask price for the call was 135, 144. So what I'm gonna do is I'm gonna click here, and Thinkorswim is gonna give me the midpoint, which is 139.5. So let's call it 140. So let's say the next day at the open, well, actually, if it's the next day, then I need to change that. So 1 second, guys. So 515, 516. Let me see if the next day we went above the red UFO. The next day we went, yes, the next day we went above the red UFO, okay? So let's say on that 21st, okay, on that 21st. So let me 16. Okay, on that 516, you bought the 80 call, and the 80 call was now worth 183. Okay, so let's say you paid 183. That was the next day. Okay, so buy the 80 call, paid 1.83. Okay, so from there, two things may happen. It starts going up, and you start trailing your stop, and you start being very happy, making all times high, or it moves against you. So we know it did move against us. Okay, so let me see what happened next week on the 23. What happened on the 23? So that stock started moving against us. Okay, so at this moment in time, you're still within your plan. You're still doing what you're doing. It's what it is, and no, not a big deal. Okay, keeps moving against you. One more week. Okay, now it's falling more. It's really not too much fun. Okay, but you are just following your plan. Okay, now we're getting into May 6th. I'm just keep moving 1 week at a time, just to be a little more visual. Okay, and at that moment in time, it started moving your way. Okay, and up to this date, today. So I think it's $87 a share, something like that. So then the trade worked very well, and in this case, you never had to switch to damage control mode because it never crossed the 72 line. Okay, but let me go back to that date 516. So let me go back to 516. Okay. So coming back to this chart, now what in my mind it's really exaggerated is the fact that we entered up here, and basically we were open to risk $6. I mean, we were expecting, let me do a little bit of a mathematical calculation here. So from 78 to 72 is $6 out of 78. This is like 7%. So we were kind of like happy and ready to see the stock move against us by 7% just to see if we're wrong or not. Okay, so in this case, which is, I draw it like that at the beginning on purpose, just to have this example number one, which is you didn't have to switch to damage control mode. So hopefully the example was adequate and you appreciated it. But at the same time, in my mind, that example is not realistic enough, in the sense that in this trade, you are really placing your triggering condition for you to switch to damage mode way too far. It's like you are this Formula One racer on the starting grid, and not only your engine didn't turn on, but now on top of that, you are waiting for the other car just to pass you 3 or 4 times for you to decide, okay, time to switch to damage control mode. So that makes no sense, okay? So we need to always, when it comes to switching to damage control mode, we need to have conditions where we don't act too soon and we don't act too late, okay? And it's always a little bit of a difficult call, especially because stocks are depending on some other external forces, okay? But certainly it's the way to do this properly would be to be looking at not only the stock but other parameters too, okay? So now with the stock, you could go ahead if you want to be a little bit in the aggressive side and just move this particular purple line below the new UFO that just formed. You could do that, but now you would be relying on only one UFO. And the problem with that, I would strongly recommend you to not to do that, is because now you are assuming that UFO is going to work just as good as in futures or Forex. And again, it's not the case. It's a stock. Stocks are depending on external forces. So in order to define better your condition for you to switch to damage control mode or not, it's either you have multiple UFOs and you place the line all the way below, which, obviously in this case, it's too exaggerated, it's too much. Or you also look at other markets, okay, key markets such as the S&P 500. So, look at the S&P 500 and see if the S&P or the Nasdaq or other markets, okay, the S&P doesn't give you any green UFO. So let's look at the Nasdaq to see if the Nasdaq has anything green we can rely on that date. Okay, it's just loading. Okay, so while it's loading, I will just say what I would normally look at, which is I would look at the key market indexes in the same time frame as the stock. And two things may happen. You find UFOs that you can use as a reference, or you don't. So if you don't, then what you could do is also look at different time frames. Okay, go for the larger time frame, in this case the daily. Okay, and that way try to find a place on the chart where you can define a triggering condition that tells you when you are wrong a little sooner. Okay, so for example, with the Nasdaq, let me try to reload the 55 minute time frame to see if it loads. Okay, now, so with the Nasdaq, here we go. With the Nasdaq, I got 2 green UFOs. So it's not 1, it's 2. Okay, and by the way, with the Nasdaq, you will normally, with the indexes, you will normally use pre and post market. Take a look, 45% UFO performance. If you switch to pre and post market, it will become of a greater value. Okay, so just downloading the data. Okay, so you see with the pre and post market, you got 55. So here you have 1 UFO. The purple line is pointing out where the other UFO was. Not ideal, not ideal. What about the S&P? So with the S&P, I have 1, 2, and 3. Okay, so with the S&P, I do have more UFOs. So then what I can do with the S&P is put my line in here. Okay, so normally I would look for a minimum of 2 UFOs, and unless I have a collection of UFOs overlapping each other, like 3, 4, so then I would just look at the whole thing like it's one big one. But if they are separated from each other, if you got distance between the 2 UFOs, I would just pick a minimum of 2. Okay, so this is the S&P. I'm loading the Dow Jones as well. Okay, so looking at the Dow Jones. Okay, it's taking a little bit of time to load. And I'm coming back to Starbucks as well. I'll be back with the Dow Jones in a minute. So here's Starbucks. With Starbucks, you can also see that at the moment when this trade is being executed, so we have a new green UFO that formed. Okay, so this green UFO can also be a place using the stock itself. Okay, because this is now a daily time frame. Okay, this is now a daily time frame. Okay, so you could be looking at the Dow Jones. You can be looking at the Nasdaq, the S&P. So with the Dow Jones, okay, we also have a collection of UFOs, okay, in here. Okay, so then the idea will be, if Starbucks is moving against us and the Dow Jones crosses this line, or the S&P crosses, changing to S&P, and the S&P crosses this line, okay, the Nasdaq we had nothing, or Starbucks itself crosses the line 76 that was defined by the daily time frame instead of 72. Okay, instead of 72. So then, and you could program this in TradeStation as alerts, okay, or just watch it manually. By the way, normally when I do damage control stuff, I don't do it like a stop or a target order where you do it based on the price and that's it. I normally do it at the end of the day. I look at it and I apply my damage control trade the day after. Okay, so I am not looking at timing like something critical when you do damage control, because as you will see as well, especially for the non-directional trades, we will have to do some a little bit more advanced options analytics that will take a little bit of time. Okay, so you would either use the common or the edge time frame, correct, Lisa? You are basically looking for a place where to have a line on the chart that could be a triggering condition where that line makes sense. Okay, so on the stock, I didn't have two UFOs on the 55-minute time frame, so then I had to switch to the daily to find that UFO. Okay, and that's how I come up with the line at 76. If I didn't have anything on the stock, then I would use the S&P or the Nasdaq or the Dow Jones, okay, and look in all those markets for two UFOs where to place the line below. If I didn't have any UFOs on the S&P, on the Nasdaq, and the Dow Jones, then I would look for the daily time frame to place my line, okay? And again, I'm just giving you a little bit of a long explanation here on how to put the lines in place, because damage control will never be as straightforward as planning a trade and entering a trade. Planning a trade and entering a trade is a piece of cake. We just follow the steps and that's it. But doing damage control implies first defining when do you switch mode from normal mode to damage control mode, and that's often not too easy. Okay, that's often not too easy because you may have or you may not have the UFOs. And second, once you hit that trigger for damage control, then you will wait until the market closes, and then as the market is closed, you will do your options analytics on the Option Station Pro to plan on the hedge. Okay, to plan on the strategy we're going to enter to try to offset the problem, and you will execute it the next day. So it's not critical to execute anything at a specific time, and certainly, especially with the non-directional trades, you will need a decent amount of time doing some exercises with the Option Station Pro in order to adjust the strategy to be used for damage control. So we cannot just use 76.07 and have an automatic order that is going to do something there, because it probably would be a little bit too rushed. Okay, so keep that in mind. Switching from normal trading mode to damage control has many changes. First, when you are just planning a trade at the beginning, you just plan the trade, place the order, done. Follow the steps. It's simple. It's super simple, super easy. But when you switch to damage control mode, so there are many moving parts now where you will need to spend a little bit of time to adjust them, and therefore you are not going to be able to execute trades, like you would do with a limit order, for example. You will need to wait until the market closes, do your analysis, and then place an order the next day. Okay, so it's the good news is that it's quite relaxed. Okay, so you don't need to rush. But the bad news is that probably you've got very used to step one, do this, step two, do that, step three, do that. And with damage control mode, it's a little bit more flexible. There is a little bit more moving parts, and sometimes actually you cannot even switch to damage control mode. It's like that Formula One driver that the engine didn't turn on. Well, you wish to switch to damage control mode, but what if the engine doesn't turn on at all in the end? So then you lost the race, right? So this will also happen sometimes with options, where you will do some analytics to try to fix it, and you will realize that, hey, you know what? I don't get to any place that is significant or worth it, so I will not do the damage control. This could also happen, okay? Especially with the non-directional. Okay, with the directional, it's easy, as you will see. So let me see. Lisa, so stock first 55 minutes or day. If no UFOs, then equity ETFs 55, then day. Well, first, Lisa, let me rephrase it because the way you wrote it makes me think maybe I didn't say it clear enough. So let me rephrase it. So first, you will look at the edge time frame with the stock, which is 55. If the stock doesn't give you the UFOs, at least two, then you will go for the daily on the stock. And if you don't get anything on the daily with the stock, then you will switch to the indexes on the 55 and look at least at two UFOs. And if you don't get it, then you would switch to the daily on the equity index markets. And if you don't get it, then there is no damage control mode possible. Is that making sense? Subhash, you cannot plan for damage control mode before the trade because you will see that there are adjustments. Okay, so you cannot. So we are reassess the trade at the end of the day to determine if we need to set up damage control. Yes, correct. Yes, very good. Perfect. Thanks for that, guys. Thanks for clarifying on the comments box and so on. So anyway, so now we have a new definition of the example number 2. Example number 1, the definition of damage control was 72. So in this case, you never had done damage control. Example number 2, we have now a more realistic definition of damage control, which is 76. Okay, and so let's see what happens 1 week later. Okay, so 1 week later is on the 23. Okay, this market went down and hit the trigger. Okay, now the trigger was hit on what day? That is the 23 actually. Yes, 23. Yes, so the trigger was hit on the 23. Okay, so let's pretend now it's the 23 at night, in the evening hours or afternoon, depending on where you live. And next thing you know, you look at your market and you're like, okay, yeah, so this thing moved too much against me. It's now time to enter damage control mode. So what do you have at this time? Okay, what do you have at this time and how are we gonna do this? Well, what you have at this time, okay, what you have at this time is that you are long a call, and therefore you have some positive deltas. Okay, the call you on, okay, the call you on carries some positive deltas. Okay, that's what you have in your account. In other words, if the stock keeps falling, you will get more and more and more hurt. Why? Because you have positive deltas. Remember, positive deltas is like being long. Okay, it's like being long. Remember, we learned last weekend that plus one delta is the same as long one share. Same thing. Okay, that's what plus one delta means. So because you have positive deltas on the call you on, you are long X amount of shares. So if the stock keeps falling and falling and falling, you will keep losing, right? At that time, because you hit your triggering condition, your assumption is, okay, this market went too much against me. So even though the stocks are fragile and they're influenced by external forces, the fact is that no external force is helping at all. And I hit my triggering condition, so that stock may be changing its condition completely, and that stock may fall to 60. So if the stock falls to 60, what am I going to do now? I am long deltas. I am positive delta. So I mean, you know that you paid $181 to buy the call, so the most you can lose is $183 to buy the call. So the most you can lose is 183. But at the same time, if you were to do nothing at all, and it keeps falling and falling and falling and falling and falling, then you will end up in a very, very problematic situation. Okay, so what could you do? Well, this is the time where the technique for damage control I would like to expose you to today for directional trades would be, it's time to enter X amount of short shares. In other words, short stock against the call you own. Why? Because if you short stocks, this is like adding short shares. The short shares you add will counteract the long shares you have, because you are positive delta. This is like being long. So now if I add short shares, that will provide negative deltas or short shares, and therefore I will neutralize my delta. Okay, I will neutralize my delta. So then what would you do? Okay, well, you would just go take a look at your option chain on the 23. Okay, on the 23, you will go take a look at the 80 call. 80 call, and you will look at, for that 80 call, what is the delta you get. Okay, and the delta you get is 29. Okay, at that time on that date, the delta of your option, okay, was 29. So what are we gonna do? Well, when I say enter X amount of short shares, but to be precise, we're gonna enter 29 shares of stock short. That's what we're gonna do. Why? Because 29 shares of stock short produces negative 29 delta. isn't it? So 29 short shares equals minus 29 delta. One call that you have equals positive 29 delta. So the net result, okay, would be 0 delta. So you have neutralized the pain. Okay, you have neutralized the pain. Now, the goal of damage control is not to only neutralize the pain. Because if you start last in the race and you neutralize the pain, that means that you stay last in the race. So the idea is to try to get back some benefit. Going back to profit is not clear, okay? Because it would require a lot of fighting, right, in the race to go back to points. But at the same time, damage control mode doesn't mean, or neutralizing the trade doesn't mean just paralyze it there and that's it. We want to add something active in this process that allows you to minimize whatever amount of loss you have at this point. At this point, okay, the value of the 80 call is 98 cents. This is the value of the call that particular day. Okay, so you paid 183. The call dropped to 0.98. Okay, this is a loss of $85, if I'm not mistaken, per call. Okay, so the moment you add 29 shares of stock short, you are gonna be paralyzing that loss to be 85. But the goal is not that the loss stays at 85 forever, because if you want this, just close the call. Close the call, you get $85 loss, and that's it, end of the story. So the goal of neutralizing, okay, that net result of making it 0, okay, the goal of neutralizing here, okay, is that neutralizing is just the beginning. Okay, neutralizing is just the beginning. Because why is that just the beginning? Because the call you own has positive gamma. Okay, and I'm not going to repeat what we learned last weekend, but because it has positive gamma, so what's going to happen now is that if the market falls and keeps going down, okay, the delta of the call will drop from 29 positive to, let's say, 10. So if it drops from 29 to 10, right, but you are short 29 shares of stock that remain 29 because stocks don't change delta, so what's going to happen? Well, that would be equivalent to you are short 19 shares of stock and the stock went from 76 to 73, so you are making money. In other words, your 85 loss becomes 70, becomes 65, becomes 60, and you are reducing the loss. That's damage control. If the stock was to go back up, okay, what happens? Well, your short shares remain as 29, but your call becomes 30, 35, 40, 45, 50. So if the call becomes 50, so 50 minus 29, okay, gives you a net exposure of 21. So if the stock went to 80, from 76 to 80, you made $4 times 20, that's $80. So instead of losing 80, instead of losing 85, you are only losing 5 because you recovered $80 of profit after neutralizing the trade with the shares of stock. Does that make sense? Of course, if you didn't neutralize, okay, you would have made much more. But did you know for sure the move up was going to happen? Actually, no. After this move down, you stopped trusting that stock because you hit your triggering condition to switch to damage control mode, right? And therefore, even though the stock may recover, the stock could certainly have dropped again. And what's the beauty of doing this? Well, the beauty of doing this is that from this point, no matter if it goes up or down, you start reducing the size of the loss. And if you do have a humongous move, either up or down, then you go back to profit. Okay, you go back to profit. Let me take a look at your questions, and I will give you more details here. So let me see. Maka, wouldn't that require a large account? It depends. Okay, and we talked about that last weekend as well. It depends. Initially, I would say yes, because using shares is much more expensive compared to using options. But you are only using 29 shares. It's not like you're using 100 shares. So it doesn't need to be that much. Second, if you were to do this in a very large account, you can apply for portfolio margin. This is only above 125K. So not everybody will apply for portfolio margin, but if you are above that, then with portfolio margin, you will need extremely little money because you get a huge, massive leverage for shares. Option number 3, if you live outside of America, you can use CFDs instead of using shares, and you get 10-to-1 leverage. That's another option too, and it's only 29 shares, isn't it? And option number 4, if all of the above failed, you can go ahead and use a deep in the money put, okay? And a deep in the money put will technically behave very similar to shares, and therefore you will be able to mimic that in a very similar fashion, okay? But again, realistically, normally when you do this, you use shares, okay? Because you also want to keep it simple, and also you want to make sure that time decay will not hurt you, because if you are long a call and then you buy a put, even though it's very deep in the money, if the stock recovers greatly, okay, well, the in the money put is not in the money anymore, so you would need to roll it, and it becomes too complicated, okay? So shares of stock is normally the way to do it, okay? And again, remember, we are talking about a scenario where you have a problem, and you are trying to fix a portion of it, and obviously this will imply adding something else in the account, and adding something else will imply more buying power, okay? Good. Mario, hi Jose, can we trigger the damage control mode looking at a minimum delta reduction? I would not do that, Mario. I would be more objective with the price movement and the UFOs. That's going to be more realistic, because remember, the delta depends on the value of the option, and the value of the option depends on many things, including expectation for the future. So if people was to get scared, or people were to get over relaxed, next thing you know, your delta changes too much, and now it triggers your condition, but it means nothing. So I would not do that. Okay, I would just use the UFOs. If the call is close to expiry, do we need to roll over? No. The plan for this trade, the beginning plan of this trade, is to hold it until the day before earnings, if you haven't reached your target. That's the goal. If you haven't reached your target, hold it until the day before earnings. So there is no rolling, because if you were to roll, you would now go through earnings, and earnings are a recipe for gaps, and now this is a gamble, okay? John, when would you get out of your short stock that you sold for damage control? You would not, John. You would get out the day before earnings, or when you get to your target. You would not get out, because getting out of your hedge is like entering a new trade. Okay? So what you would do is, if the price, John, goes back your way, okay? So let's say, for example, after this, the market goes back your way, right? And now, as it's going your way up, it gives you those beautiful UFOs, right? It keeps going, another UFO, and now you're back in business, now you're in profit, right? And your target, let's say your target is much higher, all the way there, right? But now you're moving your stop here, okay? And when I say stop, it's not a stop, it's an alert, because we're not using stops, right? But you create an alert, and now let's say that stock goes back and triggers your alert. And this is a condition that you use to exit the trade, okay? Just like you would exit the trade when you get to the target, you exit the trade also because you hit that condition, right? So if that was the case, then you would get out of the whole thing, the call and the shares. But getting out of the shares only is something that you would not do, because that would be equivalent to re-entering a trade. And re-entering a trade means that you will need to reassess everything from the beginning, which is not what we are doing. Here we are just in damage control mode, trying to fix the outcome of the race. Is that making sense? Okay. I think we can short stocks for 20% of this price. You will need 25% intraday and 50% if you hold it overnight, Dirk. In Indian market, we cannot sell shares based on delta requirement. How can we apply damage control in that case? Subhash, you can use single stock futures, but definitely you will have many limitations which are inherent to the Indian markets, where the regulation is quite restrictive. That unfortunately we cannot change. Yeah. Lisa, I will need to play with this on analyze to. Yes, absolutely. Yes, and of course you want to do this with a demo account first with paper money as well. Okay. But anyway, let's take a look. Let's take a look at this. Okay. So what do we have here? So you got in here, you shorted 29 shares of stock. Okay, let's do the math. You were talking about how much money you need. So you will need 29 times, let's call it 76. Okay, and with a margin account, you need half of that, so that's $1,000. Okay, so $1,100. This is what you will need to be able to do that. So again, it's not like it's that much. I mean, it's more than the options. The option cost you 183, so it's 10 times more. So I get it. Okay, but if that recovers you from a loss or cuts the loss in half, then it's money well spent. Okay, because we always have extra buying power in our accounts, isn't it? We are never fully invested, right? So now, so from here, yeah. So now let's see what happens. Okay. So let me go for the next day, for example. Okay. I thought I double clicked. Okay. Now, so let's say we now go for Monday 27, for example. So a couple of days later. So what happened on Monday 27? Okay, so now the stock started bouncing, go back where it is. Okay, so what's going to happen? You are more or less in the same place, 85, 84, 83, 88, something like that. That would be the net result, because the short shares didn't make money, didn't lose money, because the stock is in the same place. And the option about the same as well. So what if 2 more days pass? So now is May 29. So now the stock is falling. So now is May 29. So on May 29, if you look at the result, okay, so May 29, okay, on May 29, the 80 option is now worth 60 cents. Okay, why is it worth 60 cents? Well, because the market failed. So the market failed, the option loses value. Okay, so then the call dropped further to 60 cents. Okay, so now the loss you would have accumulated on the call itself, by itself, would be $123, right? Yes, 123. So from 85 now you are losing 85. Sorry, from 85 now you're losing 123. Why? Because Starbucks kept falling down. Okay, so that's where you are. But again, you don't have the call by itself in the account anymore. Now that call has a companion, which is 29 shares of stock short. So what does that mean? It means that from 76.07, that market went down to 75.29. That means that the market fell by 78 cents. And you are short 29 shares, which means that you have made $22.62. Okay, you have made $22.62. So when you add, okay, when you add the hedge profit, okay, of 22, okay, you are now in a net loss of 101 instead of 123. okay? And you may say, hey, wait a minute, but I'm still losing money. Yes, you are, because the distance that price traveled from 76 to 75.29 is only 78 cents, okay? So again, when you switch to damage control mode in this fashion, you need a significant move up or down to begin seeing results, okay? So if the stock stays more or less here, then everything is going to be about the same, especially if the stock slows down after a move. What's going to happen is that the options buyers get more relaxed, and therefore expectations for future price movement is less. Technically, this is called volatility, and when volatility drops, the prices of the options shrink, and in this case, it shrinked from 98 to 60. Okay, where if the stock moves, the value of the option shrinks less, and you get more benefits from the 29 shares where you're short. So the worst thing that could happen is that that stock stays quiet there in a zone for a while. This is where this will really not help you. It will really not help you either. It would really not hurt you either, but it will not really help you, okay? And which is the idea is that we certainly want this to help, okay? So then we need to wait for a larger move, okay? And the thing is that we have no control, right? So we just need to let it be, okay? Now that you switch to damage control mode, let it be. So 1 week later, okay, 1 week later, this thing now really moved, and now it's a significant move. So what's happening now? Okay, so that would be on June 5. So now you are in June 5. Okay, so June 5. And we are looking at the 80 call. Okay, so the 80 call now, it's 2.25. Okay, the 80 call now is 2.25. 80 call, the call went up to 2.25. Okay, so 2.25 means that now you have a little bit of a profit on the call, small profit on the call, okay, small profit on the call, which is, let me do the math. So 225 minus 183, that would be 42. Okay, so the call now is giving you a little bit of joy. Now what's going to be very painful now, is going to be the stock, okay, because the 29 shares that you have moved from 76.07 to 79.96. So 79.86 minus 76.07, that means that now you have a move of $3.89. This multiplied times 29 shares, this is giving you a loss on the shares of 112. Okay, so you now have a loss. Okay, so net loss, the net loss is 112 minus 42. You're losing 112 on the stock, you are making 42 on the call, so you are now losing 70. Okay, so again, net loss of 70. Now, you may say, oh, but I'm not making money. Yeah, of course you're not making money. It went all the way against you, and you hedged it, right? So what was the goal? And this is why I made the comments I made at the beginning, because it's very easy to forget, okay? Because we all like to make money, so we forget. The goal of doing a damage control trade was to take that number and try to improve it, okay? Try to improve it. Coming back to profit will happen from time to time, but most of the time, the outcome of this type of action will be to reduce that. So right now, we achieved that goal, which is to reduce it, okay? Two things may happen. It may fall again. So if it falls again, what happens? We'll be reaching that value again. If it falls again, we'll be reaching that value again. If it falls a lot, well, now we'll go back from 85 to 70, 60, 40, if it falls a lot, you may end up making a small profit if it falls a lot. Okay? What if it keeps rallying? Well, if it keeps rallying, you will go back to profits as well. Okay, so let's go back to the current date. Let's go back to the current date. Yeah, exactly, Lisa. So the current date, okay, which is July 5. So July 5. At the current date, the 80 call is 765. Okay, that's the 80 call, 765. So after all these amazing move, okay, so the call went up again, up to 765, if I am not mistaken. Yes, so that will give you a nice profit on the call, which is 765 minus 183, which is how much you pay to buy the call. That's 582. Okay, so 582. So nice profit of $582 on the call. Okay, now with the shares, you got some pain, isn't it? Because the current price of the shares is 87.79, while you shorted at 76.07. So this is $11.72 that it's a move that you have been suffering at a rate of 29 shares times 29, right? So that is $339 of loss. Okay, so if you add up, right, the 582 profit minus the 300 something loss on the shares, you are now in a net win of this. Okay, so I'll copy this. So 582 minus 339.88, you have a net profit of 242. So you are back in business. Okay, you are back in business. And you know, again, the beauty is that in this case we had the move up. In the end, funnily enough, we were right on the direction. We were just wrong on the timing, but we were right on the direction. So in the end, we were right on the direction, right? But what if you were totally wrong on the direction and it went all the way against you? Well, if it went all the way against you, the same thing would have happened. If it moves a little, it's more or less the same amount of pain. If it moves a little more, it begins reducing the original loss of 85 to be a little less. And if it moves a lot, now you start profiting again. And in this case, the beauty would be that you profit, but you were wrong on the direction. Here you profit as you are right on the direction, but you will also profit if you were wrong on the direction. Okay, so this is a simple to implement damage control mode for directional plays, even though you need to put a little bit of thinking. And I call it simple because it requires the use of shares against the calls. Okay, or you can do the same with the puts as well. Okay, if you are long puts, you can just go long shares. Okay, you get negative deltas from the put, you get positive deltas from the shares. So you get shares against the option. Okay, that's how you do it. And in that sense, it's simple because you only need to place an order, which is an order with shares. And the amount of shares happens to be the delta of the call the day you hit the triggering point. Okay, so it's not too complicated. Okay, but how do I put it? It's fun to watch, right? Because if it goes down after you hedge, you know, you're like, oh, this is happening. If it goes up, oh, this is other happening. If it was to go down again, you're like, oh, whatever. And if it goes down more, now whatever. And you know, the outcome of a trade keeps changing depending on what happens. Okay, and as things are happening, you know, you will just find yourself identifying those green UFOs, and whenever you're in profit, set an exit below the UFOs and just exit the trade, having converted a loss into a winner. That will be the goal. And this will be applied for both directions. So anyway, let me take a look at your questions so I can clarify this. Yes, Lisa, you're correct. The price of the stock has to move. If the stock was to remain like doing nothing, then you would end up taking the whole loss, which is the 183, which, by the way, those are the 183 you were happy to assume in the first place. Does that make sense? But in order for that number to reduce, then you need the stock to move. So with commissions, you may still be at a loss, but do you have any rules on how much risk you will apply to damage control? No, well, damage control, the size of the trade is determined by the delta. Okay, because remember, you need to end up with a neutralized delta at the beginning. So it's not about how much risk you want to take. The moment you add the shares, you actually neutralize the risk. Okay, so worst case, the stock doesn't move, and then the risk is the same. Best case, the stock moves, and then the risk is less. And if you're lucky, you get a winner. Okay, which most of the times when you do this, you will end up with a lesser loss. Going back to profit, like in the case of Starbucks, is because we did have a pretty significant move, okay? Which is not always the case, okay? So make sure you keep that in mind, okay? And this is how I started the session. The goal of damage control, sometimes we forget, I guess it's human, I guess it's greed, I don't know what it is, but sometimes it's easy to forget. The goal of damage control is to end up in a better position instead of the position in which you are. The goal of damage control is not to do magic. I wish we could do magic in the markets, but the fact is that we cannot control the markets. Okay, so what we could do though is try to be as smart as possible. And in this case, being smart brings one benefit, and the one benefit is to take a loss and reduce it to be less. And ideally, in few cases, you'll have one of those humongous moves, and then you make a profit, even if the move is totally against you. As long as it's large enough, you make a profit, even though you were wrong. Must be risky. Okay. Miral Patel, how do you pick the proper delta? You suggest low delta strike price? Miral, I believe that you got confused there. The delta sets the amount of shares. So the delta you have on the call, it's whatever the market gave you, right? So on May 16, that day, you bought a call. And that call had whatever delta it had. But on that day, that was May 24, you hit your triggering condition for damage control. And when you look at the option chain, and you look at the delta that day, I'll do it one, May 23, the delta that day was 29. Because the delta of the call is 29, you short 29 shares to neutralize it. So you don't need to pick high delta or low delta. You just pick the delta you are given by the market. You are not buying an option, you are shorting shares. The amount of shares is the same number as the delta. Yeah, can you please explain how in the... Well, yes, Subhash, I'm reading your question. The only way, I mean, given the fact that you need 29 delta, okay, given the fact that you need 29 delta, and if you take an deep in the money put, that put will have close to negative 95 or something like that, right? The only way to be able to do it is that you had a large position size with multiple calls, okay? Because by definition, an in the money put will have more than 50 delta, and if you want it to be deeply in the money to mimic the stock, so then it's going to be around 95 delta or 100 delta, 99, something like that. So the only way, given the fact that we need 29, then the only way to be able to do this is that you have multiple calls. Okay, so again, I'm giving you choices, but bottom line is that to do this, you'll use stock shares. That's the best way to do it. Orlando, thank you, Jose. I have to run now. No worries, my friend. Will there be rules for damage control as part of your main notes documents? Why did you pick 80 strike? The 80 strike Miral was picked on the May 16 date by following the rules that we utilize every single Thursday when we do the get-together session. This happens to be the call that you bought on that date. It has nothing to do with the damage control mode. This was picked the day of the trade. Okay, so if you're not familiar with the rules, I would suggest that you watch the recorded sessions that we have in the YouTube channel. Watch the option sessions, and certainly watch the Thursday sessions when we do options trading, and that way you will be able to learn that. Okay. Exactly, Subhash, you got it. Perfect, everyone. Okay, guys, so let me give you 5-minute break, okay, and we'll come back in 5 minutes, okay, and we'll continue with more damage control, but this time for non-directional trades, okay? Very good. So 5-minute break, my friends. Hey everybody, we are about to restart. 30 seconds. Please go ahead and confirm in the chat box that you hear my voice, so that way we'll be ready to go. Okay. Okay, everyone, very nice. Ready to restart and continue now with another approach, which is applied to non-directional trades. Okay, so we have been talking about damage control with directional trades, where the idea is to use gamma, and this is done by using shares of stock against the options trade. Obviously, there are other approaches as well on how to do damage control for directional trades. To be honest, there are many approaches. There are many things that could be done with options. Okay, all of them got pros and cons. Again, we need a starting point. So this one, the one we covered today, has certain advantages, and hopefully this is well understood. I strongly recommend you all, guys, that if you're going to use damage control, you practice it in a paper money account for a while, so you get to internalize the outcome of the strategy. Because as you can see, the moment you throw gamma into the equation, it gets us thinking, isn't it? And some of the things get a little, maybe confusing is too much or too strong as a word, but a little bit, a little bit maybe yes. Okay, so I strongly recommend you to do some practice. Now, for non-directional trade, we cannot take advantage of gamma because, as you know, non-directional trades by definition are negative gamma. So gamma cannot help. Actually, if you were to use shares of stock against an iron condor, for example, if the stock was to move, it would hurt. Instead of, with directional trades, the more the stock moves, the more it helps. Well, because the gamma is negative with the non-directional trades, then it would be the complete opposite effect, and therefore we just cannot use shares of stock against a non-directional trade such as an iron condor. Okay, so we're gonna have to look at other different possibilities. Okay, and the first option I would like to give you, which is the one we're going to cover today, it's using theta, which in other words, we will want to reconvert the condor into something different, basically shooting for locking in some of the theta profit already made and add more theta to the equation, which basically will have one simple outcome, which is to lower the cost of the trade. Sorry, not the cost. Let me repeat that. Lower the risk of the trade by increasing the total credit collected and therefore the total theta collected, and at the same time redefine the range that we had defined initially in the original iron condor. So tweak it a little bit with the evolution of this trade when we do the damage control. Okay, so we're gonna use theta. This will mean that we're gonna reconvert, an iron condor. Okay, I'm gonna apply this to iron condors. So we're gonna reconvert an iron condor into a different option strategy. In order to lock in prior theta profits and add more premium to reduce the risk of the trade while redefining the range. I'm gonna call it the expected range. Okay, that would be the idea. Okay, and again, same thing is gonna happen here. I'm gonna explain it to you. I'm sure you have questions for me. Please feel free, and please make sure you type them so I can give you the answers. But you will see in the end, it's not complicated, but it will get you thinking. And therefore, the way to develop a good level of understanding and confidence to do it yourself will be that you practice it for a while in a paper money account before you start doing it with real capital. Okay, so let's go for it. Okay, so let's first pick a stock. What do we have here? We have non-directional IBM stuff. So let me see, IBM for example. Let me go ahead. Let me go ahead and look at July 17. Okay. Okay. Give me a second, guys. One sec. Let me see, what can we do? Let's see. I'll look at Citigroup. Okay, so it has earnings on July 15. Okay, so still loading, pending data. We're just gonna wait. Okay, so Citigroup, you can see it here, has earnings on July 15, as you can see here. Okay, so July 15 is the earnings date. So let's pretend that some time ago I did an iron condor with Citigroup and I was using July 12 expiration, which is next Friday, because July 15 is the earnings. So I was using the expiration right before. Okay, let's pretend that this is the case. Let me see why it's taking so long to download. Okay, here we go. So, so what do we have here? So let's say we are planning the trade. This is on June 26. So let's say we are back in time and it's June 26. So June 26. So I'm gonna get Citigroup here as well. June 26. Okay, so I'm loading the historical prices for the options. Okay, I said that we were going to use July 12 in this case. Okay, so I'll be looking into that in just a sec. Back to the chart. Really taking a long time to download. Okay, so here we go. So let's say you were doing an iron condor on June 26, and basically you see those two red UFOs, you see those two green UFOs, and basically you tell yourself, hey, you know what, I believe that from now until July 12, which is right here, I believe that that stock is gonna stay between the UFOs. Okay, let's say that's the case, and therefore you decide to use the 69s. Okay, you do an iron condor where you bought the 70 call, you sold the 69 call, and then on the put side you sold the 66 put and you bought the 65 put. Okay, using July 12, 2019 expiration. Okay, so let's say that this is the trade that you have done on that particular date. That was June 26. Okay, Hopefully everybody follows. Okay, if it's not the case, please let me know. Now, so let's get the values. Okay, so let's say you did this trade, and you sold the 69, so that would pay you 62. Okay, 62, and then you bought the 70, you pay 37. Okay, so 62. Let me write it down. So that one is 62. That one, I think it was 37. 62 and 37. 62 and 37 correct. And then on the bottom side, we have the 66 and 65, which is 86 and 62. So 86 and 62. Okay, so this is a condor where if you have done this, you have collected 62 plus 86, so you have collected $1.48 of premium, and then you paid 37, and then you paid 62, so that gave you a net credit of 49 cents. Okay, so net credit, okay, so net credit, initial net credit is 49 cents, and initial risk is 51. Okay, 51 because it's 1 minus 49. Okay, 1 is the distance between strikes. 69 to 70 is 1. 66 to 65 is 1. So the most you can lose is 1. But for you to risk 1, you get paid 49. So the most you can lose is 51. So the initial risk is 51. Okay, and this is the trade. And of course, if that stock remains in the purple box until July 12th, then you made 49 on time decay. That's an iron condor. I guess not a surprise at this point. Okay, but now two things may happen. Two things may happen. Everything goes well, or something doesn't go well, and then a damage control situation is triggered. So let's see. Okay, so now instead of June 26, let's say it's June 27. So on June 27, we got some movement. Okay, we have some movement, a new red UFO form. That is actually good news. Okay. What about the next day? So the next day would be June 28. So on June 28, we totally broke the range. Something dramatic happened to Citibank, maybe the broad market, maybe the financial sector, whatever. But the fact is that we broke the range. Okay, so now you are entering the problematic territory. Okay, so you are now in problematic territory. Okay, so what will you do on that date? Okay, what will you do? What you would do on that date? This is 6/28. Okay, so what you would do is take a look. So 6/28. Okay, the put side, that was the 66 and the 65. So notice how the 66 became 27 and the 65 became 15. Okay, so the 65 became 27. And the 65 became 15. Good. Okay, became 15. So obviously the put side is producing a profit. Okay, the put side is producing a profit, but the call side is not. The call side is producing a loss, right? So 69 call, the 69 call is now trading at 182. Okay, when you sold it, the 69 call was 62, but now because the stock went up, it's now 182. Okay, so you are in a problematic situation. So what can you do? Well, what you could do, okay, one option on how to do the damage control, because now damage control has been triggered, isn't it? You are outside the box, so damage control is triggered. So one thing that that you could do is close the put side, okay, and reconvert the call side into something different. So let's do it. First of all, I'm gonna close the put side. If I close the put side, okay, if I close the put side and I got the 86, the 66 puts, I sold it at 86 and now I can close it at 27. That means that I make a profit of 59 on that put, okay? So if I close the put side, I am making plus 59, okay? But also I will be losing some money on the other put, isn't it? Because the other put was sold at 62, sorry, was bought at 62 and now I will sell it at 15. So that means that I will lose 47. So 59 minus 47. That means that by closing the put side, I would make a small profit of 12. Okay, so here I would collect 0.12. This is a profit from the put side. Okay. Now, I'm not going to leave the call side the way it is. Okay. Remember what we said is that we're going to reconvert. I remember using that term when I wrote it here. So reconvert the iron condor into a different option strategy. Okay, so I close the put side because now if this was to fall down, then the puts would hurt, and since I made some profit, so since I'm in a problematic situation, let's lock this profit in. This is the theta profit I was talking about. So lock it in, okay. And now what I'm gonna do is I'm gonna take those calls and I'm gonna do something new. Okay, so let me write it and then let me explain what it is. So what I'm going to do is I'm going to sell another of the same 69 call. Okay, I'll sell another of the same 61 call, and then I will buy another call below the 69 at the same distance between the original calls. In other words, the distance between the original calls was 70 minus 69. That is 1, right? So the call I will be buying will be below 69 by the same amount, which is 1. So then it's going to be the 68 call. Okay, so in other words, let me move this text here. So I started the trade by buying the 70, selling the 69. So what I'm going to do now is, I'm going to sell another 69. So I will be short net 2 69s, and then below I'm going to buy the 68. Okay, I'm going to buy the 68 below the 69 SL. Now, for the ones of you that know about options trading, this is a butterfly. Okay, it's like an iron condor. Okay, it's like an iron condor. In an iron condor, you have the call above and the call below, and then much lower you sell a put and you buy a put. That's an iron condor. An iron butterfly is when you have the call and then you have the put, but then the ones you sell are in the middle and you sell two of the call. Sorry, not the put, call. Okay, so you are using the same strikes as the extreme. So that call would be using the same strike as this call with the put. But then instead of using a short call and a short put above and below, you just go for the midpoint. Okay, This is what is known as an iron butterfly. And I will graph it in a minute, so you get to see the effect on the chart, okay? Now, if I do that on that particular date, which is June 28, so on June 28, the 69 call pays me 182. So the 61 call pays me 182. And the 61 call, I will need to pay for that. And that one would cost me 261. Okay, 261. So let me write it down. 261. So think about what is the new risk of the trade. Okay, so this trade now will collect a total credit of 0.62 plus 1.82 minus 0.37 minus 2.61. Let me look at this again. So 62 plus 182, that's 244. Okay, so here's where we have situations like I was telling you before, that when you want to do damage control, there are times you can do it, there are times you cannot do it. Okay, it's not always that you can do it. So for example, in this case, if I buy the 68 against the 69, it's costing me too much money, and it will not produce a credit, it will produce a debit. Okay, it will produce a debit. So let me see. Yeah, 0.62 plus 182 minus 261. So that's a debit of 17 plus the 37. Okay, got it. So look, the best way to show you this is gonna be by graphing it. Okay. So let me get Option Station Pro, and you will understand that. By the way, you guys have been super silent for a long time. Could you please give me a little bit? Yes, well, you would, Lisa, I see your question about rechecking at the market open. You would just do it. You know, the next day you would just do it whenever possible, or if you were to do the day before, you know, during market hours, it's fine too. Remember, it's not critical. The timing is not so critical anymore when you switch to damage control mode. Okay, so switching to Citigroup. Moving back to July 12. So let me go ahead and let me do this. And hopefully I will not confuse you too much, guys. So just let me do this first, and then I will explain everything, and you will be okay. So I'm just gonna enter 6 legs, 6 options, because we'll have the original Iron Condor, which is 4, and then we have the conversion of the Iron Condor to be an Iron Butterfly, and that's 2 more, so 4 and 2 is 6. So I'm just adding everything in here, and then I will explain. Okay, so let's begin. Let me move this up a little bit. So first, to one below, I will just uncheck, and I will work on getting the values that we know, which is 69, 68. So 69, 68. Oh, yes, I can see I made a mistake. So 69, 68, and then we will have 66, 65. So let me put it all together here, and you will see how cool and visual it is, and it will be well understood by everybody. And 66 and 65, and by doing this, I just realized I made a little silly mistake earlier. So I will explain that in a minute, okay? But anyway, so we have the one on the top is 37. Okay, the next one is, oh wait a minute, 70, not 69. 70. And 69. Yeah, 70 and 69. So the 69, the 70 cost us 37. The 69 paid us 62. Getting there. Okay, so you can see I got the calls. 70 paid us 37, 69 paid us 62. So we paid 37, we received 62. Okay, this is the beginning of the trade. Then we have the bottom part, which is 66.65, where the 66 paid us 86. So 86, and the 65 paid us 62. We paid 62. Okay, so this is the condor. Okay, notice how I have selected the 4 one on the top, but the 2 below are unchecked. So even though we have them on the screen, just pretend they're not there because they're doing nothing at the moment. So 70, 69, 66, 65. Okay, and this produces this beautiful graph for us, where you can see the blue line is the data at expiration, where you can see the simulation tells us that the most you can lose is 51, which is I calculated this manually earlier, isn't it? So the most you can lose is 51, and if you're right, you will make 49, which is what I said before. Now for you to be right, the stock will need to remain between this point and this point. Okay, if the stock drops below 65 whatever, or rallies above 69 something, then you are in trouble. Okay, and what happened here is that the stock rallied above that 69 something, so we're in trouble. Therefore we switch to damage control mode, and the damage control mode will imply to sell the 69 and buy the 68. So we're going to take another 69. Okay, so we are selling another of the 69 calls, and below we will be buying the 68. Okay, below we will be buying the 68. Now, when I do this, okay, when I do this, the new 69 will pay me 182. So I need to customize this here. 182. Okay, so 69 call, it's 182, and then for the 68 call, we said it's going to be 261. So 261. Okay, and now if I was to activate all of this, okay, this gives me a totally different risk profile. And now notice that the maximum risk is 130. So I went from $51 of risk to 130, and this is absolutely wrong. Okay, and why is this happening? Well, this is happening because what I told you here is that we need to close the puts. Okay, we need to close the puts, but in my simulation I have not closed them. Okay, they are still here. So what I need to do is I need to uncheck the puts. Okay, I need to uncheck the puts, and after I uncheck the puts, okay, I also, remember, I just collected 12 cents of profit by closing the puts. So in order for me to be able to simulate that I collected 12 cents of profits, what I'm going to do is I'm just going to pick randomly this one, okay, and I'm just going to add, instead of 62, I'm going to make it 74, which is like I have been paid 12 cents extra. Okay? If I do that, notice what happens. I got a different risk profile graph, where now, notice how the most I can lose is 42. Okay, so my maximum loss was going to be 51, correct? But after doing this, okay, the initial risk is 51, but after doing this, okay, the new risk is now 42, okay, instead of 51. So hey, I am in a situation which is problematic. It's looking like I'm gonna lose. If I lose, I'm gonna lose 51. Let's do something to let's switch the mode to damage control. And by doing that, next thing you know, now my risk is 42, which you may look at it like it's a small value, but just do the math, okay? So if you reduce from 51 to 42, you reduce 9 cents. 9 cents out of 51 means that I reduce my risk by 17%. So, and again, every time it will be different, every stock is going to be different, the strikes will be different. That's the thing about damage control. You need to come here and work with the simulator to find out, how things will be, okay? But in any case now, your profile has been redefined. Now, the place where you make the most is 69. If I go back to the chart, 69 is here. Earlier, the place where you make the most is here. And if I had done a normal iron butterfly, let's call the midpoint is more or less here. So what I have accomplished by doing this? Well, by doing this, what I have accomplished is that it's kind of like I took the bottom square, and it's kind of like I push it back up, something like that. So if this thing keeps going and going and going, so then I will lose 42. But if it stays where it is or comes back down a little bit or somewhere in here, then I will make money. Okay, I will make money. So I have redefined the range, and this is quite convenient because I also redefined the range at a time where I am getting closer and closer and closer to July 12, which means I got more time decay, I got less statistical opportunity for price to move further away, because the less time you have, the less time you have to move, right? So you are getting closer to July 12, and therefore, this is producing a benefit when doing that. Not only you reduce the risk of the trade, but now you have the purple box has been pushed up a little bit, readapting to the new market condition, which, if you think about it, is looking like it's a trend. Okay, it's a new trend that is developing, and probably now this thing is gonna have a greater probability of moving up instead of moving down. Okay, and again, is that gonna always be the case? No, there will be times where, and this is damage control, guys. So there will be times where this thing now from there just falls all the way here. Okay, so what happened? Well, it didn't go up, even though it looked like an uptrend. It didn't go up; it went down. Okay, but what's the good news? You lost 42 instead of 51. Okay, there will be times where, if you had done nothing and just waited and hoped for the best, it will come back here and you would have made your 49. Okay, where now, if it comes back inside, okay, let's say it finishes at 69 something, so instead of making 49, you will make 20. Okay, so it finishes at 69.39, you make 20 instead of 49. Okay, but again, you also converted the 51 risk, that was the initial risk, after something non-expected happened that triggered you to be in damage control mode. So you converted the 51 into 42. And when you do these adjustments, guys, you will have different cases. Sometimes you will do a conversion of an iron condor into an iron butterfly, and given the current level of premium and the price of the stock and the amount of time to expiration and all those different factors, which every case will be different. So when you do that, there will be cases where you end up with an iron butterfly, which is amazing. Like the $51 risk becomes 10 or something like that. It's like really, really powerful. There will be times that the $51 risk stays 51 or becomes 55, and then you don't do it. Okay, so there are times where you cannot do damage control, where it doesn't make sense. And there are times, which is the majority, where it makes sense doing it. And when you do it, the greatest benefit is to reduce the risk. In other words, you end up losing less than what you planned at the beginning, which is always a very important thing to be done in trading, minimize your losses, right? And you accomplish this goal by doing that, okay? But anyway, guys, give me a little feedback. How is it going so far? Everybody's okay? converting those iron condors into iron butterflies. Now, no need to check volatility, Subhash. You are doing this as you are getting closer to the expiration date. And by the way, it's damage control. You are not entering a new trade. So if you were to enter a new trade, of course, you need to control volatility. If you are doing damage control, you are just trying to protect yourself. You know what I mean? So you just do it, okay? And what would happen, I mean, you have a very good point, that's for sure, Subhash. So what would happen is that if the volatility had really dropped very much, so what would happen is that instead of getting paid 182, you will get paid, 140. And if you get paid 140, look at what's happening to your risk. It's 84 instead of 51. So what would you do? Well, you would not do it. Okay, you would just not apply damage control. You would just follow the plan of the trade and wait until you either price goes back to the range or you lose 51. And that's it, okay? Because there is nothing else you can do, okay? But normally that's not the case. When you break a range, it's because price is moving. It's because price is moving. And when price is moving, then volatility spikes up. And therefore, this will be 180 something. Okay, is that making sense? So you don't need to recheck. Basically, by you doing this analysis on the simulator, if you take your initial risk of 51 and you can lower it, then you know it's worth it to do it. If you cannot lower it, then volatility got crushed, and then forget about it. There's no way you'll be able to do damage control. It's like that the racer that had a problem with the engine and is thinking about, okay, let's try to start the race last, and let's try to work on the strategy on how I change the tires and stuff like that to maybe gain a few places at the end of the race, and hopefully that's damage control. Well, that's great, but what if the engine doesn't restart? If the engine doesn't restart, so there is no damage control, the race is over. Does that make sense? So it's the same story here. If volatility was crushed, race is over. But normally it will almost never be the case, because for you to switch to damage control mode, it means that market that was quiet, non-directional, started pushing hard in one direction, right? And therefore volatility will tend to spike up. Mario, great. Jose, very good. Dirk, yeah, good. Woke my brain up on a Sunday morning. Very good. Love it. John, very interesting. Some more work on the simulator is no doubt necessary. Thanks, Jose. My pleasure. Yes, of course. You guys spend time looking at it, thinking about it, practice it in paper money. If you have questions, let me know as well. And by the way, it's a long time I was talking about damage control stuff, and so this is our first session to talk about this. There are other subjects we'll need to address in future sessions as well. So next weekend will not be options, okay? But we'll go back to damage control a little further in time. I will give you time to practice it so you can internalize all of this, and then we'll add more stuff as well. Okay, guys? John, if possible with Starbucks example, if you would buy a put instead of shorting shares, which put would you select and miss that part? It would need to be a deep in the money put, John. Deep in the money, so it mimics what the stock does, okay? So you don't suffer much time decay, etc., etc. If you buy an out of the money put, then you are suffering decay from the call and the put, and it's gonna kill the trade completely, okay? Very good, love it. Perfect, guys. Okay, so the session is over. It's been a super pleasure as always to spend some time over the weekend sharpening, guys. Super pleasure. Make sure you click the thumbs up on our video. Subscribe if you're not. Click on the little bell so you receive the notifications. And that way we are better connected, guys. You guys take care. Again, keep up the good work. And see you on Tuesday for sharpening short term. For get together short term. We'll be trading the futures on the Forex, guys. See you then. Bye-bye. Take care, everyone.